relevant. We got Jeremy Nelson, of course, who is a partner at Element Wealth. But the question I asked him, I'm not sure if you were able to hear it coming in studio, but we got this recent Supreme Court ruling about the EPA, and basically forget it that it was the EPA. The Supreme Court, essentially what they ruled is these agencies, these bureaucratic entities, they can't just go out and start doing things that really was not explicit in law. They've got to be reined in somewhat. And what the court said is, the EPA, they really sort of overstepped their bounds here. And there's probably, Jeremy, no other industry that has that situation than the financial industry.
Absolutely.
The banking industry.
Absolutely.
Most regulated in the country.
Yeah.
And Dodd-Frank just ratcheted that up substantially in 2010. And that's what we were talking to Gordon about. I remember to the point where the community banks in particular, they couldn't make any loans.
Oh, it made it absolutely too difficult.
You couldn't do it.
Yeah.
And so some of that's been rolled back. But I just wonder how the Supreme Court ruling might affect the regulatory purview and scope of all these government agencies. And a lot of folks may not realize, unless they're in the banking industry, it's not like they come in for a couple of weeks and do an examination and they're out. It's every day. It's like it's perpetual, and it's a cost that they bear. And what happens to that cost? We pay for it as consumers. That's just how it works.
At the end of the day, that is 100% true. And look, I'm all about appropriate regulation, protecting consumers,
especially your money.
Exactly. But at the end of the day, the regulation goes so far, and it hurts the consumer because it raises the cost of compliance.
There's no doubt about it. And I remember talking to so many bankers who were despondent about it right after Dodd-Frank. We want to make these loans, but we can't. We can't make it fit within the framework, the regulatory framework. And if we do it, and then we get examined, well, then we have to pay fines and penalties and whatever other consequences that the bureaucrats come in and levy on you. But it's almost like every single decision that is made in that industry is always with an eye and an ear towards what are the regulators going to say.
And what I would say with regard to the regulation is, obviously you had the financial crisis, and there was a response to it.
And that was the point.
And it just went too far, like most of the time. And now you're starting to see things maybe get back a little more in line, a little more practical, because what you don't want to do is inhibit the economy with overly burdensome regulation.
Absolutely. Right? Yeah. I mean, and it's. The banking industry is just one that came to mind because I think it's not in the minds of a lot of people, not in sight, but behind the scenes, it's a gigantic bureaucracy of regulation.
Well, we see it. There's kind of been an explosion of private credit.
Right.
And so there's a lot of different investments that retail people can get into that now might have sleeves of private credit in it, where that wasn't common previously because the big banks stopped lending to corporations, so they had to go to the private markets in order to get debt.
No doubt about it. I mean, I've talked about it before. I financed my company's acquisition strategy through that same route. You don't go to a commercial bank and say, hey, look, I want to borrow some money to go buy a company. They laugh at you. They don't do that.
And it costs you more money to go that route.
No, exactly.
Yep.
A lot.
Yep.
So most people would say, you paid what for that money? But that's a whole nother discussion. But as it pertains to markets, something that Gordon did share that I found rather comforting was that he said that he's not seeing and hearing from his members, the banks here in Mississippi, a contraction in demand for loans and credit. Look, they're selling money.
We've been pretty steadfast on this, that we don't really see a real recession on the horizon. Right. So a couple days ago, I was on a call with Blackstone, right? Blackstone's the world's largest private equity manager. And we were having this conversation. And I said, we had this negative GDP number in the first quarter, but nominal growth, like just actual how big the economy is, it grew quite well in the first quarter. It's just net of that inflation, right? It was negative.
Yeah.
So it creates what could be a a technical recession, by the definition of the book, but it's not a real actual contraction, right? We're not we're not producing less. We're just, when you net the inflation out, we're not moving ahead quite fast enough. As the inflation comes down, which we 100% believe that it does, you're seeing commodity prices coming in. Gasoline futures are down 20%. I filled up 2 days ago. Yeah, I still paid a lot for my gas, but those future contracts are down 20%. So that means that in the coming months, you're going to see gas prices come down probably in the neighborhood of 20%.
Yeah, $80 for June, up 23.
Yeah.
Crude is what I saw.
So as you see the commodity prices come down or the energy prices come down, that's really going to help out. There's also reason to believe food costs are going to be coming down. And so as you get later into this year, those inflation numbers are likely going to be coming down. So maybe we brush up on a technical recession, but it's not a real contraction in the economy. And we're seeing it from our business owner clients. They haven't slowed down. Okay.
Well, that's good to hear.
Yeah.
That's really good to hear. So I had a question on the C-Spire text line. If I finance 2 cars in 2020 and a house in 2019, would it be worth me looking at refinancing? Probably not right now. We've got an increased interest rate environment relative to 20 and 19.
Unless your credit has really improved and your rate could drop, probably not.
Right.
I have not seen a single loan over the past 6 months that touches anything we saw over the last 3 years.
Well, and the refinance market, it's pretty much dried up.
Oh, it's dead.
Yeah. Nobody's refinancing now.
Yep.
So, and for 2 reasons. One is they probably already got a lower rate.
Yep.
And 2 is if they do have a higher one, let's wait till it comes back down.
Absolutely.
Right.
Yep.
That was the other. I think that would be the other aspect of that decision.
Yep.
So we're watching these tumultuous markets, as Rhino likes to describe. It's like a kangaroo jumping up and down.
Yep.
We got the NASDAQ on track to be up 400 plus points this week. It's down today, mainly because the 10-year's up.
Yep.
But are we at bottom? I'm just going to ask you, what do you think, and what, in your professional opinion, and in your circles?
I would say with 75% certainty, we've probably seen the bottom.
Okay.
There's a chance that, we could touch down lower, but not a lot lower. I think that we are setting a bottom. Like we talked about 8 weeks ago when we first came in, we kind of said, look, as we get into the summer, we're going to be going through a bottoming process. I don't think that we're quite ready to lift off. You got, probably another 75 basis point rate hike in July from the Fed. Once we digest that, once we get kind of through the summer driving season, we start to see some of these the gas prices and inflation coming down.
Travel.
Yeah. Then at that point in time, I do think things set up. We have begun, for clients that came to us with cash, we this week actually started to systematically deploy a little bit, right?
Okay.
We're not guns a-blazing
Well,
yet.
that's why the markets are up, because everybody, I think, is thinking like you, and they're nibbling.
Yeah, we're nibbling. We're still a little bit cautious, but we actually really think that the outlook for the next 12 to 24 months is pretty good for the market.
Okay.
Yeah.
Well, and the other thing is, I start thinking about these big tech names, which are so attached to the 10-year because they're growth stocks, and if the expectation is that their future earnings is worth less as a result of inflation, that's what usually causes them to retract. But these are quality companies, and what I hear that's kind of the resounding message from your peers, your world, financial advisors, is we're looking for cash flow. We want companies that are producing good cash flow.
Yeah, we've moved away from a world where we're focused on just future growth and we're worried about actually making money.
Yeah, that's what they're looking for, right?
Yep.
Okay, and it makes total sense. You can hang around with us.
Absolutely.
We got Jeremy Nelson, a partner at Element Wealth, in the Element Wealth studios. We'll step aside here and come right back. We've got Jeremy Nelson, partner at Element Wealth. So one of the things that comes up a lot, Jeremy, when you talk about investing, most investors, individuals in particular, I know you deal with a lot of those, haven't really thought so much about income-producing assets, especially just low-risk, interest-bearing securities, because there hadn't really been any income for a while. I mean, so the downside of having cheap credit when you borrow money is it also means you don't get a lot on your money when you invest it for interest.
It's been a borrower's market.
But that's changing somewhat.
Exactly.
There are more opportunities. So I had a question here. Will CD rates reach a point where they could be enticing, especially with market all over the place? Where are we on the typical bank money market now?
Well, so bank money markets haven't quite kept up with where the Fed funds rate is. It's just a little bit less right now. But, yeah, look, if the Fed goes another 75 basis points and then they take rates up to 3, 3.25, which we talked about a few weeks ago, then you're going to start to see money markets pushing up towards that 2 and 3%. I would not go and lock my money in for a long-term CD right now.
Yeah.
Right. Now, maybe if I want to do a 6-month or a year, because I do firmly believe that over the next 12 months that rates are going to be higher and you will be able to then lock in a much better rate. Okay.
Well, that makes sense. But you don't see returning to the 8% CD era that we had back in when the mortgages were 17%.
Yeah,
so
absolutely not. The inflation, we believe, is going to come down.
Okay.
Right? Inflation cures inflation in a lot of cases. So we've said, we think that we could see Fed funds go up to 3.5% to 4% over time. But once you start going beyond that, it creates a lot of destruction economically, which would then create more deflationary pressures versus inflationary pressures.
And that's the so-called needle that the Fed is trying to thread here, is to avoid the hard landing where we crash into a recession and we see lots of job loss, et cetera. That's what we're trying to avoid.
Yeah, but I also think that they know how far behind they are. And in your last segment, you talked about this, but this jobs report really gives them cover to do another 75 basis points. And so, we said this last time, they're going to shoot inflation down first and worry about growth later.
Yeah.
And that's what they're going to do. So, and what we're seeing in the commodity markets, like we talked about last segment, we really see the inflation numbers starting to come down as we get later in the year. And
Powell's statements reflected what you just said, is that we're focused on inflation, and if that means that we've got to recede somewhat, so be it.
Yep.
I mean, he's signaled that to the market in writing in the minutes. So, And the other thing is, from an investment perspective, is the dividend stocks. Mm-hmm. A lot more attractive in that respect as well. They're having to entice folks to put their money, invest in their equities, and so they're giving more attractive dividends.
Yeah, so dividend-paying stocks are a great retirement asset because they provide you some long-term growth opportunity, also current income. Right now, they're still paying, a lot of them are still paying more than buying a 10-year treasury. So you can get more income than buying a bond, and you get some long-term benefit of owning stocks.
Sure.
That ratio is changing, though, right now. There's a lot less that are paying more than the 10-year with rates going up.
I got you. Any you like right now from a dividends perspective?
Well, we can't give the securities recommendations over the radio.
Okay.
But, I'll say that we see certain companies that are trading 12 times earnings, 4.6% dividend, and they've raised their dividend for 46 or 54 straight years. Yeah, I mean, there are some of those that are out there, and all your listeners are always welcome to call us, and we're very happy to give them a recommendation. Just can't do it over the radio.
The point, though, is there's opportunity for income that we haven't had with the growth that we've experienced because of the growth. I mean, that's really been the opportunity. So now growth, at least right now, is fairly level, or not to the degree it was the last couple of years.
Yeah, and a lot of these dividend payers are companies that have pricing power and over time will push the inflation through to the consumer, therefore increasing their earnings and increasing those dividend payouts. So the biggest mistake that I think that people make when they're investing on their own, buying dividend-paying companies, is they look for the highest yielding companies.
Okay.
Hey, this one's going to pay me 5, whereas this one's only going to pay me 2.5. Well, this one that's paying you 5 is probably putting 100% of their profits into their dividend.
Okay.
Where this company's maybe putting 1/3, and they're continuing to grow. And that inevitably what happens is dividend cuts.
That makes sense.
Right? So you really want to focus when you're buying dividend-paying stocks, companies that are going to pay you a good income today, but also that are going to be able to raise that dividend over time.
What about corporate bonds?
A lot better than it was. So credit spreads, so the difference between what a corporation pays and a treasury, right? There's a spread there.
Yep.
Have widened out a little bit. So not only are you getting the benefit of the increase in rates, spreads are a little bit wider. So you're even getting more than the increase in rates.
Okay.
Wouldn't go way out too long term. Still think there's a kind of a sweet spot in the probably 2 to 3 year range right now in the bond markets, where if rates continue to go up, you're not going to wait 10 to 20 years before you're going to get your money back and be able to reinvest. So keeping it a little bit more short term absolutely makes sense.
And you want to hang with high quality there too, right?
Yeah, especially if you're buying individual bonds, right?
Okay.
If you're an investor doing it yourself and you're buying individual bonds, you probably don't have the capacity to do the in-depth research on junk bonds to figure out what you want to buy.
May look awfully,
Too much risk.
Too much risk. Awfully attractive, but and what about municipal bonds? I mean, the rates are somewhat up there too. Of course, they're tax-free for federal purposes.
Rates are getting better, absolutely. Still, probably if you're buying individual bonds, keep it in that 2-3 year range. See where rates go. And then you can begin to stagger out and buy, a little bit longer term.
Yeah, but of course, the best part is you handle all that kind of stuff. I don't have to worry about that.
We do, and I'll tell you, our tune is changing. We were concerned last year. We really felt like the market had gotten a little bit overvalued ahead of itself. We knew that these rates were going to have to go because we started to see the inflation. But right now, I think everything is reset to pretty reasonable levels. Maybe not dead bottom, but an interesting statistic. So we had a 16% down quarter in the S&P 500. If you go back and you look at all the cases where you had a quarter where the S&P 500 was down 15%, post-World War II, 87.5% of the time it's positive the next quarter. 6, 9, 12, and 24 months out, 100% of the time it's been positive. So we're starting to get, a little bit more optimistic. We're kind of dipping our toe. I don't think being fearful and panicking and selling is the right thing right now. I think that, be patient. Investing is still a long-term game, even if you're nearing retirement, and with an eye to get a little bit more aggressive here.
We got midterms coming up. What does the investment community think about the possibility of having essentially divided government and gridlock?
It's a massive positive. So if you look historically speaking at midterm election years, you get your weakness in the first 2 quarters into the third quarter, and you tend to rally through the midterm. And midterm years typically are where the pendulum, right? General elections, they swing way out, and then the pendulum comes back. In midterm years, the market likes divided government because it inhibits any major legislation from passing and changing things.
Yeah, they're uncertain when you've got one party in charge that could pretty much have their way and do anything they want. That's that uncertainty.
And then next year is the third year of the presidential election cycle.
Okay.
Post-World War II, there was only one negative year in a third year of a presidential election cycle. It was 2015, and if you include dividends, it was slightly positive.
I'll be darned.
Yeah. So we really see the inflation coming down. We see valuations more reasonable. The Fed's got cover to raise rates. We're kind of ripping the Band-Aid off here, and we believe that it starts to set things looking up pretty good as we go later into the year and into next year.
Gotcha. Well, all that I think is optimistic, but more importantly, feels a little bit like we're at capitulation point.
You got to be a little bit contrarian, right? When everyone's selling, you got to start looking and go, well, maybe it's time to start looking at buying.
Got to have a stomach to do it, huh?
Exactly. It's a tough business.
It is. Jeremy, appreciate you coming in. Always insightful. Thank you.
All right. Appreciate it. Thank you.
Jeremy Nelson, partner at Element Wealth. We'll come right back. Final segment on Middays when we return.